Kouky, welcome back, mate. Wow, what a year. The stuff that's happening for 2025, property prices, interest rates, people's ability to borrow, what the Reserve Bank's going to do on the 17th and 18th. New board meeting. Is this the first meeting of new board?
No, the new board meeting is not until the 1st of April. The new board takes effect at the 1st of March. So this is the last meeting
of the old board.
Of the traditional old board.
Right.
So do they want to leave us with a bit of good news, or do they want to keep us under the thumb a bit longer?
Well, what do you reckon? So let's just get through this the early stage because I've got a whole lot to talk about.
Yep.
Inflation. Well, let's do the easy stuff first. Unemployment. So often you talk about in your chart the unemployment number as being a bit of a benchmark indicator to the RBA as to whether they should put rates up or down or leave them where they are. Where's unemployment at the moment?
Since we last chatted, we had the December monthly unemployment number. It went from 3.9 to 4.0%. And that is still within, and I like to make this point, that it's still within 0.5% of being at a 50-year low. About 18 months ago when we got to 3.5%, that was the lowest since 1974, heaven forbid.
Wow.
Now, it's gone up as the economy slowed down, and a lot of people, including Treasury, including the RBA, and dare I say all of the bank economist teams that I look at, were expecting that unemployment rate to get to 4.5, 4.7, 4.8. It's still at 4.
Even the RBA modelled it in.
Even the RBA were 4.5, yep, or thereabouts. Now, the fact that we're at 4% is a good news story. You know, just take it away from interest rates for 1 second. You know, you and I have had this conversation for years and years and years. I like an economy where everybody has a job. You know, that's great. You know, everybody's got a purpose. They're earning money. It's Goldilocks, yes, and they're working. They're earning money. It's good for society. It's good for the economy. It's good for everybody to have very low unemployment. It's bad to have high unemployment. You know.
That is for sure.
That's a good story. That's a good story. When it comes to interest rates, for those people who've got chunky debt or, you know, sort of holding their breath for rate cuts during the course of this year, they're sort of saying, well, and the RBA is saying the same sort of thing from their statements of late last year. When the unemployment rate, and I'll use too low in inverted commas, is too low, what it means is that wage pressures are probably high because there's a shortage of labour.
When you say too low, in other words, everybody's employed effectively.
Yep. And I want to hire someone, I can't find anybody, so I've got to put wages up.
Yep.
As a business person, when I put wages up, how do I maintain my profit? I put up my prices.
Yep.
What's putting up my prices? That's inflation.
Yep.
And that's what the RBA is fighting against.
Yep.
So it's not the RBA being mean, you know, oh, got to get unemployment up. You know, they're not being, you know, tough, you know, nasty people. They're using it as part of their model for forecasting where inflation is going to be. And this is where that 4% unemployment rate is certainly debatable at the moment, because it's actually happened when wage growth is still pretty decent, 3.5%. But what was it? 6 months before that, it was 4.3%. So wages growth has actually come off the boil with an unemployment rate of 4%. And as we're probably going to discuss in a minute, the inflation rates come down quite nicely, including the trimmed mean in the December quarter. And so the RBA is sort of weighing up all these sort of things and thinking, well, hang on, you know, remember the narrow path that the previous governor, Phil Lowe, talked about? The narrow path, just to tell everyone, was he wanted to get the economy along the path to get inflation back on target without causing mass unemployment. You know what? They might be damn close to achieving that.
And what's interesting about that, or what's sort of let's call it so shocking about that outcome potentially happening, was generally speaking, if inflation's high and the interest rates go up, unemployment usually follows because business have to put people off, and as a result of that, people lose jobs, and then inflation comes back down
because wages come down.
And people have less money to spend, and people are a bit more nervous about their life, and people keep talking about the unemployment number, and everyone starts to sort of bunker down a little bit and spend less money. And you know, that's how they control the economy. That's how they control our behaviour. It's interesting in just conceptual or in a policy sense. It in the past, it's nearly been, as opposed to this time, it's nearly been a trade-off by saying inflation is a bigger bogeyman than unemployment. We would rather have inflation under control because inflation affects everyone. And
100% of the population.
100% of the population. It has a concentrated effect on a very large percentage of the population who are on less wages than, say, the rest of the economy. but unemployment only affects a small percentage of the population. So it's a bit of a trade-off.
Yes.
But what they've done here, what you said, is very important. Looks like they may have managed to keep unemployment pretty steady. In other words, people are mostly employed in this country. And at the same time, it looks like inflation's going in the right direction.
And that's been the remarkable thing. Now, there's still a little bit of time to go before we can put our hand on our heart and say, yeah, they've done it. But the way that unemployment number over the last few months of 2024 has panned out is giving more credence to what the RBA was doing. And so the fact that we've actually had that occurring with the wage growth decelerating and, as I said, with inflation coming down, sure, the economy's weak. We know that that's been the thing that is sort of, again, the other surprise, because, 0.8 annual GDP, normally you'd expect firms to be saying, oh, gee, I don't need to hire any staff because my business is so poor. But we've seen these hiring numbers
But
still
we know
being
where
strong.
they're hiring, though.
Well, it's in the
public sector.
Government sector, yeah, sort of NDIS and education and healthcare. So that's
an important point.
There's still jobs being created.
I was going to say, it doesn't really matter.
So in a funny way, it's a little bit like, would you prefer a business to be government run or private sector run? Now, generally, there's one or two exceptions always to this rule. Generally, private firms are better and more efficient at running a big business. Generally, there's one or two exceptions, of course. But the government does things that the private sector do because they're not profitable for the private sector to do them. The classic one is defence. We're not going to have a private sector army. So we need the government to spend tens of billions of dollars per annum on defence, on border force to protect our borders. And I think most people agree, fair enough. We want to be having our defence forces in a good position because we don't want, we don't want to be invaded or anything like that. So that's one business, if you like, we call it a business, that the government does better than the private sector. So healthcare is a debatable one. Aged care and all the NDIS and all these other things, they're debatable in education, and there are components of the private sector within that. But where that extra spending has been in the public sector that's fed into public sector jobs has been in areas that are for people in aged care. So people who sort of can't afford to fork out lots of money for good quality private sector aged care or healthcare or private schools. They go to a public school and, I want my kids and grandkids to be educated. Yeah, it's part of a good society. So we do need so it's this debate about, is the public sector always bad? No, not always. Is the private sector always good? No, not always. There's a balance. And I think we're just traversing that right now. And I think we've still got a bit of a hangover from the COVID issue where the government sector, good old Josh Frydenberg, copped a bit of flack. I think a little unfairly, because what he did to, negotiate that health pandemic in terms of the economics, yeah, there were a couple of things that might have been a bit extravagant and spent a bit too much money. But at the end of the day, we got through that with the public, voters, if you like, saying, well, the government actually did an okay job. And there is a role for government. It's not just private sector good, public sector bad. There's a bit of a role for the government sector. And that's where we sort of are with the employment side right now.
So the unemployment number, in other words, the number of people as a percentage of the total population of people employable is pretty good. It's
actually pretty good, yeah.
Our long-term average is more like 5%, but
so at 4, which is nice.
Pretty good. And so, in other words, the employment market hasn't tanked. That'll keep
correct.
That'll keep the unions happy. It'll keep generally people happy who are losing their jobs. And we know that a lot of jobs have been made available in the public sector, but we're not here to pull that apart at the moment. No. That's more a political policy issue. And we'll leave that between Dutton and Albanese to argue that one. Yes. So unemployment. We've dealt with that one. Let's look at GDP numbers. We're not really getting too much in GDP at the moment.
We haven't had one since early December. Yep. The next one comes out in about 3 to 4 weeks. In early March, we get the December quarter GDP numbers.
Yep.
They're probably going to be okay by about...
Because retail sales are sort of...
Retail sales kicked up in the December quarter.
Unbelievable.
And if you can believe it, we've had a little bit, I don't want to overstate, a little bit of an upturn in dwelling construction activity. Despite a lot of the building companies in trouble, there's been a little bit of an upturn there. And even though exports were weaker, they're not that bad. So if you put up your components of GDP, I think the latest forecast I saw from a couple of the big banks was about 0.7 for the quarter.
That's pretty good.
Which brings your annual rate up from 0.8 to about 1.4%.
Yeah.
Okay, not great, but we've got that turning point. The thing in economics is turning points. We've had that long run period of weakness. Maybe the December quarter signals just a bit better news.
Interestingly enough, those two things you're telling me about unemployment looking pretty good on their own and, GDP looking good on its own doesn't necessarily indicate a rate reduction, but we'll move on.
I know, which is where the debate becomes really interesting, which we'll touch on, I'm sure, now.
So let's look at inflation. So we got the 2.4 headline rate that came out last week, I think it was.
Yep.
That's for the December 31, which is a great. When you think about it, like. You and I are talking maybe 2 years ago when the December 22 number came out. It was like 7.8.
I think the peak was,
so it's like less than half.
Yep.
And a lot less than half. It's nearly a quarter. And of course, the trim mean, which is let's call it the adjusted inflation rate when you take a few things out, is coming at 3.2, and it's down from 3.5, which was the read we got at the end of October, I think it was, for the September quarter.
Yep.
So that's on the improve. That's very good. But there's something more. There's another, and you and I have discussed this many times over, but the quarterly number was very good.
The quarterly number for the trimmed mean, that underlying core inflation, was 0.5%.
Now, in other words, for that quarter, when you take out all the little things,
electricity subsidies,
all the subsidies, and all the rebates and all this stuff. And when you take that out, it's only 0.5 for the quarter. And then if you extrapolate that forward,
you're getting 2 point something. And just to remind everybody should know this by now, inflation target of the RBA is between 2 and 3%.
Yeah. And they want trim mean too. They're looking for
Indeed, that's their preferred measure.
Yep.
While you and I pay the headline rate, the trimmed mean sort of like a measure of demand in the economy and supply. So that whole supply chain issue from a couple of years ago, is demand too hot, all that sort of stuff. So if you look at the number that we saw in the December quarter and project through the course of 2025, even with, relatively conservative forecasts, like not just choosing a low number for the hell of it, but choosing what's probably going to be happening to inflation. What do we know about demand? What do we know about food prices and energy prices? Not with the subsidies, but oil prices and things like that. What are we seeing in the global economy? Really important for us. What's happening in China? What's happening in the US? Well, maybe not the policy of Mr. Trump, but the US has still got its economy functioning, and the Fed's still adjusting interest rates, and they didn't do it last time, but they've already cut, I think, 100 basis points. So if you look around all these things, what's going to happen to our inflation rate? I think it's pretty safe to say that when the RBA on the 18th of February, because they'll be releasing their revised forecasts, they do it every quarter. So it'll be the quarterly statement on monetary policy, 2:30 p.m. East Coast time.
It's actually 2:31.
2:31. Oh, yes, it takes a minute. You will see their revised forecast, and I'll be shocked if they don't revise down their inflation forecast. So the GDP will probably be similar to what they were forecasting, because they did have a recovery. Unemployment, they might revise down, but the thing that matters to them is that they'll revise down their trimmed mean, because the number that we saw in the quarter was considerably lower, about 0.2, 0.3 lower than they were forecasting. And nothing has happened since then to say, well, gee, that was a one-off. It might have been, something a bit quirky. No, not at all, because we're seeing all of the other things that drive inflation continuing to point to sustained low inflation through 2025. So
we're not going to get some sort of shock adjustment for school fees, education, because everything resets in Feb?
Everything resets, and they do take account of that. Well, in the
last year they did that.
March quarter, which is when school fees are usually reset on 1 January, 1 February, when the kids go back to school and stuff, they're going to be up a lot. They're probably going to be 5 or 6%. But they're only one. That's the only time of the year they change. So the rest of the other 11 months, they don't change. So what the trim trims that out, because it's a one-off big effect. And while, people pay it, they take it out because it's not really a sign of demand in the economy. Similarly with things like, when there's huge volatility in petrol prices, both up and down, they take them out. And as I said, with the electricity subsidies that the government in their wisdom have paid out, so that.
But there's only 2 more of those to go anyway.
Only 2 more of those to go. So there's all those things are trimmed out, but even we and they're the things that we know about. we are going to be getting good news on inflation through the course of this year. So the RBA will be reflecting that in their updated forecasts in a week and a half's time. And that'll be the reason that Michelle Bullock, as RBA governor, when she does her press conference after the announcement, will say, look, we've got enough information to deliver a 25 basis point cut. I think the other part of what she might say is, don't get too excited. We're not about to return to, a 1% cash rate. Yeah, we're currently 4.35. I think she'll sort of temper that language by saying, well, here's a rate cut. We can, reward the economy, if that's the right wording, because inflation's improved. But we'll continue to monitor the economy for further news that inflation's under control, that unemployment's, at a favourable level for us. So probably signaling there'll be a couple more rate cuts to come, but not 7, 8, 9, 10 rate cuts. I think we can rule that out.
Okay, let's just look at the other side of the argument, though, and we'll look at your board shortly, but let's look at the other side of the argument, though, Kouky. What about if she says, look, 0.5 is a really good quarterly number, but I want to look at what happened in the previous quarter, the previous quarter, and the previous quarter. Obviously, that's 3.2.
Correct.
Maybe I'll drop the first quarter off and I'll go 2 quarters back and do 2 quarters forward with the same 0.5 number. And I haven't got the numbers in front of me in my mind, but I don't know where that will land.
That'd probably get us down to about 2.7, if my memory's correct.
So even if we do that, it's still under 3.
It's still under 3. Now,
that's important.
It is important, just again to remind myself and you and everybody listening that with the revision to the RBA functioning that Treasurer Jim Chalmers delivered a year or so ago, while I still talk about it, the RBA having a range of 2 to 3%. So in a sense, 2.9 or 2.1 are within the range, but they're a very different inflation result. The revised wording that Michelle Bullock looks at, we're aiming for the midpoint of the target range. So they're still aiming for 2.5. So if we just, for example, if we did get through the course of this year and we had 2.9, 2.8, 2.9, 2.8, they would be a little annoyed. Yes, it's in the target range, but they want it to get more and the odd quarter when things sort of occasionally spike up or down, they're not going to get worried about that. But they want a couple of quarters where there is a 2.5.
Sustainably.
A 2.5 or a 2.4, not just on the headline, but in that core figure, in the trim to mean. Yep.
And if she says, well, the Fed didn't move and they made a mistake doing 2 big halves, and maybe they went too early because America's on fire, and Trump is now the president, and who knows what inflationary effects of his various policies that he's threatening will be. Do you think there's an argument for her to say, I just want to wait for one more set of numbers, which will be the next set of numbers will be April?
Correct.
Yeah.
Correct. Now, we still get the monthly inflation numbers, but they don't like them terribly much. They prefer the quarterly, which includes lock, stock and barrel on
let's look at the quarterly numbers. I think it's April.
It'd be the end of April, say, for the May board meeting.
Yeah.
Which I think, if I remember, it's about 20th of May, so after the election. So no good for Jim or anyone. But the issue there does come through. She might. Look, the funny thing about the RBA, since the minutes of the December meeting were released, well before Christmas, they haven't said anything. Here we are in February. A couple of assistant governors given speeches on payments and, cryptocurrencies and God knows what. But there hasn't been an RBA official, let alone the governor or the deputy governor, giving a talk about the economy. So we're going to be sort of flying blind in a sense. So that's why we tend to be focusing on what's happening globally. So your point about the US is a very good one because the Fed, having cut a few times already, did pause just this week or last week. They did pause because they're sort of saying, look, as you said, the economy's still resilient. They've got really low unemployment. They've got wages growth.
Yep.
Their stock market's on fire, so the wealth effect for American citizens is pretty good.
The Trump effect.
And, of course, Donald Trump, and without getting into the nitty-gritty, I'm not quite sure what the effect will be. Yes, I think nobody knows because that tariff issue is inflationary, but, it's going to cut taxes and then, what. So, in a sense, they're playing their own game, if you like. But if I look around what's happening in the other parts of the world, because the other parts of the world do matter. European Central Bank cut. Bank of England last night cut. Kiwis, they're going to cut another 50. Their unemployment number and their economy's shocking. They're really screwed up. Canada, they cut last week. So you look at comparable countries to us, and US, Canada, UK, Europe, and Kiwis, they're all cutting still. And they've already cut 100, 150 basis points. Now, they had rates higher than we had, so maybe they're catching up, and we're now in the pack, if you like, where we're going to be.
We're still a little bit below some of them.
We're below a couple of them. We're above a couple of them. So now we're in the middle, because I think the Canadians cut to 3, if I remember correctly. The UK cut to 4.0, and we're 4.35. So, and the Americans are still 4.5. So they're a little above us. We're sort of in the middle of the pack. But that is important for us too. Yeah, and again, we don't move in lockstep with every other country. But if you see that global inflation rate, every country's got a different inflation rate, but on the way up during the pandemic, every country went up at about the same rate, give or take 1% or 2%. Everybody's come down. So, the supply chains have been fixed, and that's a global inflation issue. Oil prices, global inflation issue. And then the effect of those rate hikes in every country, because they all delivered rate hikes, cooled the economies down.
So then if Michelle Bullock and the old board are sitting there and they're looking at, because no doubt they'll have to say, what are the reasons why we shouldn't cut? I mean, someone's going to have to put the debate up.
Yeah.
What are the reasons why they shouldn't cut?
If I was to sort of say, okay, why you shouldn't cut.
Let me put you on the negative.
I'll be on the negative. I'll have the case of negative. I would say that the reasons would be the labour market. Well, I know we've just spent a whole lot of time talking about the labour market.
It's strong.
And why it's probably doesn't go against a rate cut. But if you sort of focus on the fact that the unemployment rate is 4%, that the NAB survey, which came out earlier this week, said that firms are still having some difficulty finding labour. So by definition, they're probably having to, maybe tweak up their wages growth. I would say global uncertainty is one where we might just hold back. We'll wait and see what the Trump tariffs are.
And by the way, Kouky, I'm not saying that we won't be a rate reduction this year. I'm just thinking about wait.
If Michelle Bullock and her board come out and say we've held rates, it'll be labour market, global uncertainty, and the tariff effect. And the thing that they mentioned, it only got a line or a couple of lines in the RBA minutes, which came out last time. They said explicitly, Australia is going to benefit from the policy stimulus in China. So
which hasn't rolled out yet.
It hasn't rolled out yet, but in a funny way, we could just sit back and if China recovers, which it hasn't, just by the way, but if China were to recover very strongly, we could just sit back and think, well, we're going to export truckloads of iron ore and gas and coal, and people will visit here. A really positive issue for the Australian economy without us adjusting interest rates. So they're the sort of factors that she might be having at the back of her mind or at the front of her mind, and the board discussion on why they won't. But I think if we can call them the interest rate dubs on the board, the people who sort of are saying, we might need to trim rates, would focus on the actual inflation data and the fact that GDP is still weak. Even though we're going to get a better December quarter number, it's still below where we should be.
Yeah, so what do you think this could do if we have a rate reduction? What do you think this could do to property prices?
Yeah, look, this is obviously at face value. If there is a rate cut and it's passed on, there's a cash flow effect to
let's talk about the pass on.
Yeah.
What's the normal convention?
The normal convention.
Let's go back 20 years.
If the RBA hikes or cuts, but we'll talk a rate cut, they cut 25 basis points on the official cash rate. The banks pass it on to depositors and to borrowers.
So pass a lower interest rate on to depositors.
So if you've got a term deposit at 4.5%, it'll probably reduce to 4.25%. If you've got a mortgage at 6.4%, it drops to 6.15%.
Yeah.
Normally just passes through. Back in the day, conventional wisdom, I know we're in a very, very competitive and a very problematic market for mortgages right now. Yes. And so there's a whole lot of other things going on in the mortgage market. So that old way that we used to get that transmission from an official rate to the actual rate that people paid was pretty simple, pretty straightforward. Now with different sorts of mortgage, fixed and floating and 2 years and a mortgage offset account, I'm telling you nothing. There's a whole lot of different mortgages you can take out. So, and they're all priced differently. And they're all priced investor, owner, occupier, interest only, 25 years, 30 years. Yeah, so there's, I don't know how many mortgages there'd be. Yeah, there must be dozens. And they're all priced from a different set of inputs. They're largely the same, but there's a few different inputs and a different risk assessment. Is this loan a little bit more risky than that loan? So they're all priced slightly differently. So to say that, this is going to be pretty much a straightforward pass-through of 25 basis points across the board probably won't happen. Well, it'll be on the standard variable, they will, but I don't know how many people have a standard variable rate anymore. It's a smaller proportion than back in the old days where everybody had a standard.
You know what worries
rate.
me though? Just on that point, the vast majority of borrowers in Australia have variable rate, as you know, these days, and I think that the banks have been. I think there's going to be a debate. The banks have been chasing, because interest rates have been high and the market growth has been low. The banks have been chasing market growth against each other. So banks have been operating very tight. What I mean by that is they've been pricing very tight. In other words, not baking much margin into their loans. And the banks have been sort of not loss leading, but not too far away. There's not a lot of money in it. So 80% of the lending for prime loans just covers your cost. 20% makes money. And they're making the money in the big loans, the $1 million, $2 million loans, the big loans that they're making to people who've had a job for 5 years. There's no risk associated with them. They're making good money. They're only borrowing 65%. They're not borrowing 80% or whatever the case may be, etc. That's the big loans. That's 20% of the market. The other 80% of the market, there hasn't been a great deal of profit sitting in it. And the banks have an obligation to their shareholders to maximise profit.
Sure.
Now, and I'm not suggesting the banks act all at the same time, because they don't. They're all competitors and they all got to make their own decisions. But they're all stricken by the same issue. They haven't been making money on a vast proportion of their new lending over the past 5-6 years. Bear in mind that the government funding policy that came in during the Liberal Party government during the COVID period, these banks have had to pay all that back.
Correct.
That
0.1 term funding facility.
The TFS, TS, whatever it is.
TFF, term funding facility.
That has to be paid back, and they're paying it back, and I think it has to be paid back by the end of this year.
Yes.
So
that 0.1% money that they got, they're now rolling it over into 4 points.
Or sometimes they're hybrids. Some
higher,
hybrids were issued at 6%, whatever.
Correct.
And so the cost of funds is quite high. So, I would have to question for those people listening to this, and people should just think about this. It may not be, whilst the Reserve Bank might do its job and, because they're happy with all the data that they're getting and they may reduce interest rates. I just think people should be careful that some banks might not pass on the whole 25 basis points, or they might wait.
Yeah. You've triggered something in my mind here. If you go to the rba.gov.au website, so the Reserve Bank of Australia website, in the top panel, there's the chart pack, which is a range of, 100 charts. Love it. You've sparked one that caught my eye when I was going through this over the summer holidays, as you do. Towards the back, it might have been about the second last page, is a really simple chart, NIM, net interest margin,
and by the way,
of
that's
the banks.
Critical to us. That for all
Correct.
of us is the most
Every
important
lender,
number.
Correct. It's the most. There's a lot of important numbers in this economy. The net for the banks and the pass through of RBA rate hikes, rate cuts, all the rest of it. It is bloody important.
It's called the NIM, and it's actually called the NIM.
Yep. If listeners go to the RBA webpage, click on chart pack, and it's, as I said, it's about the second last page. There's a whole lot of stats on banks there, profits and stuff. But the one that hit me between the eyes was the NIM, and it goes back about 25 years.
Yeah, and it's been crushed.
And back in the day when Wizard came along, it narrowed.
Yeah.
So
it was 4 and it came down to about 2.4.
Correct. And then it's hovered around that up and down, a little bit up and a little bit down for years, because the competitive pressures are pretty good. Just the last couple of years, the last year, not the last couple of years, the last year, it's below 2%.
Totally
well below
crushed.
2%. It's about 180 basis points, which, okay, that's what I think what you're alluding to, which is competitive pressure a generally weak house price environment out there. We're all worried about, what's going on in the housing market. So the banks to maintain market share are, jostling with each other, which is probably good for consumers. But this is the but that I think you're getting to. When our friends at the RBA start trimming interest rates, the banks might say, "Oh, thank goodness for that. We might only pass on 10 basis points."
Yes. No, and I'm not suggesting a bank will do that, but by the way, it'll be a discussion they'll have in the Treasury Department. I can guarantee you.
Or they might do it on their high. They might pass to the full 25 on their, what do we call it, the high profile mortgage rate.
Or they might do it for new borrowers.
New borrowers.
They might just say new borrowers.
And for the old borrowers or the ones that have got a 30-year loan or whatever, they might just trim it 10, 15. 12, 15 and get that NIM, the net interest margin, back up another 5-10 basis points.
And that's their job, by the way. That's their job to shareholders, because what they've got, the NIM represents the gross profit on their operations.
Yep.
Which is the reason why NIM, by the way, and a lot of people go on about how the banks have to, or closing their branches, et cetera, every day. Yeah. Well, part of that reason they do this is because they don't make as much money out of the mortgage. And people might say, well, I don't feel sorry for CBA because it makes $10 billion a year. But at the end of the day, the reason CBA makes $10 billion a year is they're making it a much lower NIM, just that so they've got such a big book.
It's just such a one of the issues about Australia's population growth is that when we talk about immigration impacting the whole economy, labour supply and all these other things, I dare say every immigrant who comes here opens a bank account with one of the banks, and they have transactions, and the banks make money from. They get a credit card, they get a loan, they get a car loan, they get a mortgage, and that it's just what do we call it? The critical mass or the economies of scale that the banks are offering. So you can sort of get a little
but they're not
bit
because it's not because they're gouging people on the mortgage interest rate. That's sort of our point. And banks have an obligation to get a return on capital. RO return equity is a big marker for how banks are priced. And Australian banks, by the way, have an unbelievable share value relative to other banks around the world in terms of total valuations. And this might be an opportunity for banks to take a little bit back. You and I shouldn't ponder too much on it, but I just wanted to raise it because I think it's an important point. Correct. The old days, they used to pass it on straight away.
What gets passed on. And just one other aside before we move on, the RBA will look at that too.
Yeah.
They want, because the official interest rate, no one other than the banks pay it, sort of thing. They want to get if they're worried about growth and low inflation or whatever their assessment of the economy is, they want the interest rate cuts to impact on the punters out there. They want them to get that cash flow. So if they deem that a rate cut's needed and it's not passed on, curiously, they'll probably cut a little bit more than the market's currently priced in if we don't get that pass through, because they want to see the $2 trillion of mortgages that are out there, give or take. They want to see people saving some money on that so they can spend, get the economy growing and keep that unemployment rate nearer 4 rather than going up to 4.5 or 5%.
So just so I don't want to sort of give everyone brain damage, but if I could just you said something quite interesting then to me. Why would the Reserve Bank reduce interest rates? And let's assume that the banks pass them on. Yeah. And let's assume the pass-on effect is stimulation of the economy.
Yep.
When they think it's not too bad at the moment. I mean, why do they want to stimulate the economy? Is it about, Steve? Is it about stimulating the economy, or is it about stop punishing the economy?
The latter, stop punishing the economy, and it's about where the economy is going to be in 6 to 9 to 12 months.
So they always talk about the medium term.
Because a rate cut today or on the 18th of February, if that's when we get it, will not impact the economy on the 19th of February or the 19th of March even. There is a little bit of a time that the banks and other institutions pass it on. Fair enough. Takes a little bit of a while to organise these things. And then for the borrowers to recognise the fact that it's been delivered. So again, assuming it's passed on, because so for someone who's got a big mortgage, they get the first rate cut in March or April on their scheduled repayments, because that's when their next repayment's due. They save, I don't know, $100, whatever that number is per month on their mortgage repayments. They might think, oh, that's good. And then in May, they realise a bit more. And then, finally, it's not because consumers are silly. They're not. They're very, very astute. But it takes a while for that lag between when I pull the trigger on a rate cut and when it has its full effect on the economy, and it's been modelled 1,000 times, as you know, Mark, it's between 6 and 12-ish months. Sometimes it's a little bit longer if there's different things happening in the economy. But if you cut interest rates today, the full effect, there'll be a little bit of effect earlier on, but the full effect of that rate cut's not for 6 months.
Okay, that's
why the rate cut in February will have its impact in the second half, let's call it, of 2025 and into 2026.
In terms of responses and results. But
Correct.
what you've raised is why I wanted to go to this point. So because of the lag effect, and who really knows how long it's going to be, but let's say it's somewhere between 6 and 12 months. In other words, before people start to feel the benefit of a rate reduction and or rate reductions, plural. Let's say it's, July, August, maybe longer, but let's say it's sometime in the second half of this calendar year. What's important about what you just said, and I think what we should express to listeners is this. Therefore, if that rate cut doesn't really drop into everyone's back pocket for a bit of time, then between the December numbers, which came out at the end of January, the read on inflation at 3.2, trim mean, underlying inflation, and the day that this money sorts of drop into everybody's pocket, the expectation of the Reserve Bank will be that the inflation should keep running down. In other words, it doesn't stimulate day one. So therefore, if it's on its way down, if they are convinced that interest rates inflation is coming down, by the time the interest rate reduction that they announced on the 18th of February has any effect, inflation is probably going to be down at 2.5%.
Which is why we haven't spoken about the futures market, which I do love. It's not always accurate. It's always accurate, but sometimes gets it wrong. But as we sit here this morning, I checked before we came in for the recording, we do have between now, early February, and the first half of 2026, so the next 15 odd months, which is where the futures are generally most traded, we have just under 100 basis points of rate cuts priced into the futures market. So the money market investors who trade these things and the banks who borrow the money and hedge their money on bank bill markets and all this other stuff are effectively saying here and now, we think there's going to be 75, maybe 100 points of cuts between today and early 2026. So the official cash rate, 4.35 today, could be 3.35, 3.5-ish. Without putting a pinpoint accurate number on it. And to me, that's about right. And if the RBA, we'll see what Michelle Bullock says at her press conference in a week or two.
But can I just
she'll probably say that's a reason. I think she did last time. That's a reasonable assessment of what we might do.
That worries me a little bit, Kouky, and I'll tell you why.
Yeah.
Because if we look at what, the net zero proposition, if it's a 3.5, for argument's sake, let's say we get 3.35, 100 basis points worth of reduction, 3.35.
3.35, yep.
It's not zero because, there's no way in the world they're going to give us 100 basis points if they think inflation is going to be at 3.
No, that's right, correct.
It's got to be.
They need to see each number.
Yeah, it's got to be way, way lower than that. It's got to be 2.5 minimum.
It's correct. And as I said, as we said earlier, they target to the midpoint of the target range.
Yep.
And for the odd quarter, if it's 2.7, they don't care. 2.3, they don't care. As long as it's roughly 2.5.
Yeah.
But we're coming from such a high starting point.
Yeah.
And here we are. We just sort of, hallelujah, we've got it down a bit. But again, we want confirmation. It's like leading the grand final 10-0 after 10 minutes. Great start, but you haven't won the game yet. There's a lot of teams playing against Penrith have found out the last few years. It's good start and you're happy as a fan of low inflation, you'll be thinking we're on track. But then the bounce of the ball goes the wrong way. Trump tariffs do something. China's stimulus measures, a myriad of things happen. We've got an election here probably in May. And by the way, I loved both of your interviews with Mr. Dutton and Mr. Albanese. They were sensational, so recommended for everybody who missed it because they were very personal, I found, and I thought they were,
They both did a good job.
But they were both good interviews, so just by the way.
No policy. No. People.
But there will be policies involved with the election, of course.
Correct.
So Labor, Liberal, Labor, whatever, and, fine. That's what we're having a vote about, But that could come along and create some issue for the RBA. Maybe. I don't know. I'm just making this up at the moment. So that trajectory of 100 or nearly 100 points of rate cuts priced into the market, that can change. That can change very quickly as news comes out. And indeed, thinking back to that inflation number which came out at the end of January, a couple of weeks ago, that caused the market to rally and price. And before that, we only had sort of 2.5 rate cuts. So when that number came in nice and low and everybody was able to analyse it, oh, hell, we better reprice to 3.5 rate cuts being priced.
So just before we go to your table, do you think the RBA in their half-yearly review, which comes out in February or late February, I guess these days, when they after they have the meeting on the 80th, they usually
it comes out simultaneously now. That's
the same day.
Yeah, it comes out at the same time.
So we'll get the half-yearly review.
There's so much information that it's a dream for us economists.
Because she's going to be because she has been saying 2016
2026 is the time.
Sorry, 2026 is the time when we're going to start seeing inflation in the right territory.
Yes, correct.
So you reckon she will review that?
Bring that forward.
Right.
I was crunching some numbers the other day. I reckon they'll bring it forward by 6 months.
Wow. Yeah. So I think she was saying March 2026.
So I think they'll bring it through. She might be a little bit vague and say the second half of 2025.
Right. That's interesting. Very
interesting. So
whether
it's September quarter or December quarter, that was why, to just sort of hammer this point home, that was why when that December quarter inflation number came out, we saw the 0.5 trimmed mean more importantly than the headline figure. When it came out, people thought, wow. And I'm not throwing stones at anybody here, but even good old Warren Hogan, who I respect immensely, he came out and said, well,
no, Warren, he sent me a text, he said it's going to happen.
He said, gee, that's a low result.
Yeah.
And, he's as hawkish as they come.
And Chris Joy.
And even Chris, yes. So two people who are really hawkish on rates, smart economists, they know their stuff as well as anyone, who were really hawkish, and fair enough. I'm not having a go at them for 1 second. But they've come out and said, well, gee, that number has made me rethink, just like I've rethought a whole lot of things in my life.
What happens in this game? Because data, you only respond to the data.
Correct. You have your view, you form your views, you craft an argument about rates up, rates down, GDP up, GDP down, all that stuff. And then a number comes out occasionally. You think, shivers, that was a big difference. I've got to change my view.
Yeah.
Or that reinforces my view, one or the other. And that CPI mark was so big that the interest rate hawks, the ones, we've got to hike, and, again, I'm not having a go at them. But they came out and said, gee, that's amazing. I've changed my view.
I said something on TV the other day. I said, good on Australians, because they have behaved in the way the Reserve Bank governor would like to see them behave relative to what's happened with interest rates.
Correct.
We've done it.
Inflation's
down. By the way,
the business sectors.
I just want to be clear. It's no politician has done this. It's Australians.
Yeah.
We've done it.
And as I've said a million times, I'll say it till the day I give up economics, which is still hopefully 20 years away. Australians are smart when it comes to their money. I'm not just saying that because we are. And that's why interest rates are such a topical issue. I often mates in the US, why do you Australians talk so much about interest rates? It's because we love it. We've got mortgages. We want to buy a house. We've got our superannuation. We're worried about, the market went down. And even though if you're 35 years old, you can't get your super for another 30 years, or you've got a mortgage, you don't pay it off for another 20 years. We love this sort of stuff. And so that means that the discussion of interest rates and 25 basis points, if you've got a 25-year mortgage, 25 basis points is nothing in the scheme of your mortgage. But for today,
next month,
when you're forking out bloody thousands of dollars on your repayments and you get one rate cut, maybe another rate cut, and you listen to this debate and hopefully this podcast and whatever, and you think, gee, by this time next year, and here's a long time, we might get rates 75 or 100 points lower. Put that in your calculator. Fantastic. I'm going to save a couple of $100 a month. I'll be breathing a sigh of relief, and I might actually go out and spend a bit more money. That's why our Australian consumers, when they saw the rate hikes, turning it on them, went, oh my God, consumer sentiment went through the floor. Consumer spending went through the floor. Retailers, under huge pressure. A lot of construction companies, oh my God, they got hit. And that was I'll call it tough love that happened. And now we've suffered the tough love. We're about to get some real love.
So let's have a look at your table.
Fantastic.
Kouky.
Yes,
I think it's We nearly answered the question, but anyway.
Yep, here we go.
Okay, Kouky, let's look at it, mate.
Oh, mate. Look, we'll start with, and again, just before we kick off, it's these top few indicators on our whiteboard, our monetary policy checklist that are more important. So GDP, again, how's the economy going? Straight to the easing side. And while we said that there's a little bit better news coming for the December quarter, it's coming from a base of 0.8 annual GDP, weak as water. We need that growth rate to come through. Inflation, I've moved from neutral to easing. I haven't quite got it in the complete easing cycle, but we're almost there.
Can you just put it on the line, though?
I'll put it a
little bit more. That's it. I feel better about that.
Because the headline rate's under control, but again, that's been distorted by these government subsidies and whatnot. But the 0.5 trim mean, yes, we are hoping that we get another 0.5 or a 0.6 next quarter. Yeah, as I said, we're leading 10-0 after 10 minutes in the grand final.
But we look good.
I want to be leading by 10 points with 1 minute to go in the grand
final. We're leading 10-0 after the first 10 minutes and no injuries.
That's right. No one's been sent off onto the sin bin. Labour market, we've spent a bit of time on that. I'm just going to leave that in neutral because I don't think you'd hike rates because of the labour market. And remember, this is tightening, neutral and easing. It's a really good result, and it's something that, again, we should be pleased. We've got full employment or near enough to full employment. That's a mighty good thing. Wages neutral, not in the easing side because wages grow 3.5%. And to use the Goldilocks analogy, not too hot, not too cold, just right. 3.5% annual wages growth is something that workers are happy to get. Businesses are happy to pay it to retain their talent and good staff. And the RBA is happy because it's consistent with the inflation target. So right on neutral. International, I'm putting straight onto the easing side. We mentioned that even though the US Federal Reserve paused on its interest rate cutting cycle, England, New Zealand, UK, Canada, Europe are all cutting interest rates still, and they're not doing it for fun.
And China's
and China's cutting.
Yeah.
The economies are weak, so that's in the easing side. House prices are neutral because, again, just in the last couple of months, if we look at the CoreLogic monthly data, they've been flat to slightly down. Melbourne's down. Sydney's down a little bit. And even the growth in what we call the boom cities, so Perth, Adelaide and Brisbane, which were booming, the rate of increase is slowing down.
And I was talking to some agents on one of my podcasts yesterday, and they are saying there's a lot more stock around.
Yes, I've heard the same. That
people more stock.
Yeah. And that'll be really interesting to see the auction clearance rates coming up now that we're back into the normal, post-Christmas, New Year real estate market. Those auction clearance rates numbers that we get on a Saturday night will start to be really interesting. Retail sales, I'm putting that in the easing side, but on the line with inflation because there's a slightly better vibe on retail. Yes, it's coming from a shocking base. Retailers have got hammered the last couple of years, but with the tax cuts, with inflation low and wages up, that real wages equation, I'd still ease on the basis of on retail sales, but it's not as catastrophic. And similarly with consumer sentiment, we didn't talk on consumer sentiment. It's picked up. We consumers are less gloomy than we were 6 months ago. And again, we're not silly. We're alert to all the things that are going on in the economy. Maybe that's linked to the fact that everyone's got a job, which is good news. And there is a bit of relief that inflation's come down.
And people think that they're going to get a rate reduction.
And that they're going to get a rate cut. Building approvals, look, they've crept up, but that's easy. We need to build 1.2 million houses in 5 years. Mark, I'll swim across bloody Sydney Harbour if they build 1.5
Naked?
million. No, I'm not that crazy. I'll keep. Oh God, I wouldn't scare people with that. But if they get 1.2 million houses in 5 years, I'll swim across Sydney Harbour.
It's not going to happen.
Even if they get to a million, that would actually be not a bad result because we need houses. We need them. We need them. That supply issue is still there, and we're not building enough. A rate cut would actually help the construction sector.
Totally.
Help them to build stuff, to build apartments and townhouse complexes and high rise. We need that rate cut to stimulate borrowers to build that house. Business investment's okay.
And it has been for a long time.
Business investment's fine. So people are spending money on AI and technology and machinery, warehouses, as we get stuff delivered, rather than going to the bricks and mortar retail shop, we get, all the trucks and things that deliver the box from from all these people to your front door. People are spending money, businesses are spending money on CapEx. Business confidence, it's taken a little bit of a tick down as the economy slowed down the last 6 months in particular. Business confidence was really quite resilient until then, but I think the combination of what's happening globally too. I think, businesses have got an international focus. They're sort of looking overseas and thinking, oh, gee, I just better be a little bit cautious about tariffs. In fact, just earlier this week, I was talking to a number of companies that had manufacturing plants in Mexico. They're Australian companies with a manufacturing plant because it's cheap labour and all the rest of it. They're saying that the tariff stuff is causing them to lose sleep at night.
Wow.
Tariffs on, tariffs off. What do we do? What do we do? And so they're actually having a really serious rethink about what they do. So the business confidence has taken a bit of a hit from that tariff war without getting into the politics of that thing. Commodity prices, this is one, okay, the only one in the tightening cycle. Commodity prices, petrol's down, so we're paying $1.80 odd, whatever it is. Not bad. But if you look at coffee, orange juice, eggs, it's basically food. Food prices globally, and a lot of these things are traded, wheat and things are internationally traded, commodity prices are really high. And so if you're a farmer in Australia, you can supply the local market, or you can export at these high export prices. You'll sell them overseas. So we've just got to be very careful. I'm watching commodity prices. It's one of my favourite indicators and it's not just oil and nickel and copper and all that other stuff. It actually includes an oil, vegetable oil like canola, and that's the Ukraine war again causing.
How does this stuff feed back into our local inflation?
Correct, manufactured food. So the stuff that hash brown or something, whatever, which has oil and potatoes, whatever else goes into these things, I've got no idea. But the price of that stuff's gone up a lot for global reasons. Stock market really strong. I'll put that in neutral because it's going up for good reason, I think.
But it has an effect on people's feeling of wealth.
A wealth effect, yes. You look at everybody. By the time you read this, hopefully the stock market's still nice and strong. Have a look at your bloody superannuation statement. You might get a pleasant surprise. If you're not like me and you don't look at your super account, once a week or once a fortnight, and you only look at it every 6 months, go away and have a look at, what's my super done? You might just get a pleasant surprise how much is in there. If you've been contributing for 10, 15, 20 years, depending how old you are watching this. And current interest rates, they're high, they're restrictive. And again, remembering what Michelle Bullock, RBA governor, has said about the current level of interest rates, they are restrictive. So they know that the tourniquet of interest rates is squeezing the economy. They're not going to hike. We know that now. It's just a matter of when they start easing. So you look at the overall board, and as I said, the things at the top end, the top quarter of this board are the things that are really important.
So are you convinced?
Cut, probably a cut. These aren't standing in the way of a cut. It's how I describe the labour market.
Well,
they're not in the way. So I'm
not convinced for the 18th.
I'm going to put my neck on the chopping block and say they're going to deliver a 25-point cut, but the words that are spoken afterwards will be very cautious.
Okay, I want a cut, and I want numerous cuts because I want our customers to be, and everybody for that matter, to be paying less interest on their mortgage, and I want property developers to be more encouraged to build more houses as a result of things being cheaper. But I'm not convinced that the time is going to be right for February. I'm not sure what is and what isn't sustainable in terms of inflation. I'm not sure because I think some of these other things that you've pointed out could kick inflation up at a heartbeat.
Things like the commodity prices and I've got the international economy here on the weak side, but it doesn't take much, as we saw during the pandemic and that lift in inflation in late 21, early 22. It went from 1% to 5% in 6 months, and it went to 8% shortly thereafter because of those constraints.
And no doubt Michelle Bullock does exactly the same as what you've done now.
Effectively, yes.
They go through the board.
Effectively, they do.
And it'd be interesting to know what the old board, who's going to be at this meeting, says. I mean, and how do they want to go out?
Look, that's one other thing too, because the new Monetary Policy Board, which takes effect for the April the 1st meeting, has more monetary policy experts, if that's that's the reason for the reform. Should we leave it to the existing board, who don't have the monetary policy experts on board? Should they cut rates and then the new board comes and think, oh, what the hell did you cut rates for, sort of thing? But I still think that there's enough common sense from the.
Do you think they'd be talking to each other?
They're
not allowed to.
Well, the common denominator in the old board and the new board is the RBA governor, the deputy governor, the Treasury Secretary, and I think that's an okay appointment on the RBA board because Stephen Kennedy, good fella, he knows what's happening to fiscal policy. He knows what's happening to budget revenue and things like that to sort of say, oh, gee, we're seeing a bit of a surge in GST payments. Why? Why GST go up? Because people are spending money, or GST is going down. So he has that insight to just sort of give a bit of a leading indicator ahead of the official retail sales numbers coming out, because they see this revenue every day of the week in Treasury. So when you buy a bag of groceries and $10 of that is GST, they know the GST numbers pretty quickly.
So I'm still not convinced, Kouky. I just know that. Look, I know the momentum is there. The market momentum is definitely baking in a rate reduction on the 18th of February this year. I see all that, and I don't like pushing against money markets because it's usually a mistake. Yep. But we also know the money markets this time last year said there was going to be 7 rate reductions in 2024,
that's right,
starting in July or something, and we didn't get one.
Wrong. And indeed, and I just noticed from the Financial Review newspaper today, they did an economist survey, and if I'm not mistaken, there were 4 or 5 of the 30 people they surveyed, 4 or 5 people who I respect, who said no rate cut in February. So they're erring on your side.
I'm not saying no rate cut this year, but I'm saying maybe nothing in February, and we will wait. And and I think we should clear this really quickly. I do not think this will be a political decision. I do not think this RBA, particularly this board, the old board, and along with the governor and deputy, would make a decision that would be happily in the camp of helping out the government or not helping out the government.
Agree completely. I think, and I've known the RBA people for many a long day, and I think back to Glenn Stevens when he was governor, 15 or more years ago. He was asked this question in the lead into an election campaign, and he said, look, our defence forces still operate under, when there's an election campaign, our public servants who administer the age pension, the public sector hospitals still work. The RBA is still going to work. And if we need to put them up, down, or keep them stable, we'll do it because we still have our job to do.
Without fear or favour, I think is sort of their position.
I think that's right. So, but again, they know there's an election coming, but it will not influence. If they think that we've got to cut or keep them steady, they'll do what they see to be appropriate based on their analysis of things like we've just covered this afternoon.
And just one final thing, I think the listeners should get this. The RBA doesn't just sit around acting on their own. They have 500 economists or something.
Yes,
and there's a number of they get recommendations.
And the other thing that is really important to remember is that over recent years, they've ramped it up big time, their business liaison program.
Yeah.
So I do know for a fact that the very senior RBA officials have a schedule where they go around the country and they talk to a retailer in Perth, a mining company in Queensland, a builder in Sydney, and a tech company in Melbourne. They go around and, what are you finding? What are you finding about wages? What are you finding about activity? Oh, my sales are down. They're going up. And while each anecdote can be, specific to that company or that industry, they try to put them into a great big melting pot and say, well, gee, we've had 3/4 of the people saying, gee, the economy is really bad, or their order book's gone down or gone up. And they sort of blend that, what do we call it, that anecdotal evidence into their hard forecast. So back in the day, they used to ignore that and say, oh, that's just hearsay. That's a load of old tosh. Now they actually listen and they deliberately go out and liaise with the business sector, the exporters, the locals, around the whole country, every city, every region. And I think that's a good thing.
Yeah, I think they call it field officers or something along that. And so they're sort of grabbing qualitative stuff as well as the quantitative.
As well as the hard GDP and inflation numbers.
Data numbers.
They also ask, how you're finding it. And of course, they know what the banks are doing too, because they sort of they don't oversee the banks exactly, but they liaise with the other bank regulators. Say, well, are loans going up or down? How's your bad debt book going? And that sort of stuff feeds into.
Well, they also know what people's bank accounts are doing. They can say, look, overall, they're de-identified, but they do identify
the aggregate numbers.
The individuals can say, but in general, people are saving more money than they ever have before, or they're not. They're going backwards. One of the two.
Correct.
So it's a good day. It's going to be quite exciting, quite very interesting, mate. It's never as easy as it looks. You and I have a slightly different view on this one, but I do know that I don't know, but I'm pretty sure there'll be rate reductions this year at some stage. Maybe a delay, maybe on the 18th of February for everybody, some relief. But I just can't wait to listen to her conference call that she does after the announcement. I'm just dying to listen to it.
Rate cut or rate hold on the 18th of February. It'll be that conference afterwards. She talks for close to an hour.
Yeah.
And she gets, and I think the journos who ask her the questions are much better than they were. The first one, I think they were a bit sort of, like the bright lights, the rabbit in the spotlight sort of thing. Now they actually ask really good questions, and they ask, probing questions. So just assuming they don't cut. Well, why didn't you cut when transient inflation's so low? And so she'll be, raked over the coals for her view, cut or no cut or hike or whatever. Well, not a hike, but rates on hold. She'll be grilled, as she should be, because she's making a really important decision.
She does a good job.
She's good. She's a good governor. Yeah.
Very good. Thanks, Kouky.
Thank you.